2022 has proven to be a very challenging year for financial markets, with most asset classes down materially from their prior year-end highs. Unfortunately, energy transition equities have not been immune to this pressure. Despite benefiting from growing interest in energy security following the Russian invasion of Ukraine, and later the passing of the Inflation Reduction Act in the US, the MSCI Alternative Energy Index is still down 11% year-to-date as of the end of October. Indeed, we have been highlighting three key headwinds that have been impacting the space and wider equity market since the middle of last year. The first headwind, which emerged in 2021 but has continued into this year, has been the severe disruptions to global supply chains and the logistics issues and inflationary pressures that these disruptions have caused. These supply chain challenges have caused a material fall in company earnings across the sustainable energy value chain, given the reliance many of these businesses have on key materials, critical components, and smooth freight and logistics to deliver the goods and services they sell. Now, alongside this impact to earnings today, the second key headwind impacting the space has been the growing concern around future earnings as the wider economy starts to materially slow. And finally, while these first two headwinds have been impacting the earnings part of the valuation equation, the final headwind for energy transition equities has been the broader macroeconomic environment, and specifically the tightening of monetary conditions and rapid rise in interest rates. Looking forward, we are not convinced these three headwinds are fully behind us just yet. However, all three of these headwinds, as damaging as they have been this year when at their strongest, will eventually ease, and indeed in some cases are already showing signs of doing just that. And even with these headwinds, it is important to understand that the three fundamental forces driving the global energy transition, economics, consumer demand, and policy support, have never been stronger and should continue to accelerate demand for clean technologies from here. In addition to our long-term decarbonisation goals, the current energy crisis globally creates additional demand for cheap, clean energy to enhance and build up our energy security too. And crucially, for the first time in 18 months, as at the end of October, valuations across the space have finally reset to very attractive levels when taking a long-term view. It's hard to know exactly when the current market headwinds impacting the energy transition space and broader market will subside. But for the first time in some time, the fundamental outlook for energy transition equities is starting to look quite compelling. We are still positioned cautiously to provide some protection from potential continued near-term threats, but are more focused than ever on layering into long-term winners across the energy transition value chain that have strong potential upside given the valuation picture we now see.
Investment involves risk. Please read the relevant offering documents before investing.